lasting for the next several months. I'm curious, how many of you have actually attended one of our Generosity Forum events already? Okay, well, I think this is the stellar group. You're already sitting in the front row, so we're glad to have you back. And how many of you are for the first time either at the Community Foundation or at the Generosity Forum? Okay, well, welcome. Today we'll be discussing income for life gifts, charitable gift annuities, and charitable remainder trusts. And in general, I want to welcome you to the Community Foundation for those of you who are new to being here. At the Community Foundation, our vision is to make Santa Cruz thrive for all who call it home. Our mission is to bring together people, ideas, and resources to accomplish great things. We can help here at the Community Foundation with personalized services to our donors, with support for effective nonprofits, and we help create lasting legacies to support our community. I want to have, before we launch in, just to tell you about myself and to tell you a little bit about our guest speaker who will be here, and then we'll look around the room and you can meet some of our staff. So my name is Gorden. I'm our Chief Philanthropy Officer here at the Community Foundation. I've been here for about 1.5 years, and prior to my role here at the Community Foundation, I was part of the estate and gift planning team at the University of Chicago. And prior to that, I worked for the Rotary Foundation of Rotary International and their headquarters in Evanston, Illinois. I am originally from Chicago, but I did my doctorate out here at UCSC and always longed to call Santa Cruz my home. And I'm so glad that I can do so now. I have the privilege of working at this wonderful place and helping people who want to give back. Right? I'm joined here, you'll hear more from Lauren in just a moment, but I wanted to make sure that Lauren was introduced right away. Lauren Corman is an estate planning and tax planning attorney here in town. She obtained her JD at Santa Clara University Law School in 2013, and while she was in law school, she was the treasurer of the Tax and Estate Planning Society and assisted low-income families prepare and file their tax returns through the federal program VITA. Lauren was admitted to the bar in December of 2013 and now works at the Corman law offices in Santa Cruz, where she's a certified specialist in estate planning, tax, and probate law. She also specializes in taxation, business, and elder law. She is the chair of the Santa Cruz County Estate Planning Council, treasurer of the Women's Lawyers of Santa Cruz County, and a former board member of the Santa Cruz County Bar Association. So we're so pleased to have Lauren here with us today. I also wanted to recognize the staff who are in the room here from the Community Foundation, so you know that after this presentation you can address any one of us and ask for additional help. Let's start with Abby here in the front.
Hi everyone. Hi, I'm Abby Otake. I'm the Philanthropic Services Manager. Thanks for being here today.
And Susan Drew, I'm the CEO here at Welcome to the Community Foundation.
Hi, my name is Isela. I'm the Philanthropic Services Associate here.
Good morning, I'm Hillary Bryan. I'm the Donor Services Director of the Community Foundation.
And I'm Kevin Hewer. I manage the grant scholarships and nonprofit resources, and we'd love to see you back here June 3rd for our next session called Giving for Local Needs, where I'll be talking about special needs in our local nonprofit sector, campaigns that need some extra funding right now, places that have lost some key revenue. So hopefully we'll have you in the room on June 3rd at 10 o'clock.
Thank you for that excellent segue, Kevin. I did want to highlight the upcoming Generosity Forums, the next one being the one on June 3rd. So a lot of these forums are about the charitable giving tools that you can utilize to have impact. We're also talking about the different types of assets you can use to have charitable impact, such as the power of your IRA. That's going to be in October. The event taking place on June 3rd, we really hope to see many of you there, if not all of you, which is about what are our local needs? How can your generosity really power change in our community? So we hope we'll see you at the next event. So today's agenda, we're going to be talking about what a life income gift is. This is an unusual concept for a lot of people who imagine charitable giving to be a one-way transaction, right? So a life income gift is something unique. I'll be talking about charitable gift annuities particularly, which is one form of a life income gift. And we're so pleased to have Lauren here today to talk about charitable remainder trusts. We'll have plenty of time for Q&A, and as I said to one of our brave participants, please do raise your hands afterwards and let us know what's not making sense. We want to walk through a lot of these terms, which may be commonplace to those of us who have been working in the field for quite a long time, but may be brand new for you. So we'll look forward to having that robust Q&A session at the end. Okay, so life income gifts and charitable gift annuities. All right, a life income gift allows a donor to make a charitable contribution to a charitable entity and receive a tax deduction when they make the gift, and then, strangely for some folks, receive an income in return for their lifetime. At the end of the charitable gift annuity term, which is at the end of the annuitant's lifetime, the remainder goes to charity. These gifts, as I've said here, sit at the intersection of philanthropy, tax, and financial planning. So at the Community Foundation, we are one of the few entities here in Santa Cruz County that offer charitable gift annuities, right? A charitable gift annuity is a specific kind of giving vehicle that appeals to individuals who are looking to have charitable impact, but also have these valuable mechanisms of receiving this fixed income for life, and also supporting local nonprofits. Now, in anticipation of one of the questions we receive quite often about charitable gift annuities, people are curious, well, how does the income get determined? The income is determined by your age. When you make a gift to establish a charitable gift annuity, based upon your age, you're going to get a percentage payout rate. And that payout rate will increase every single year that you get older. So the idea with these things, the American Council on Gift Annuities regulates the payment rates that will go to individuals. They set the rates, so it's not a negotiable rate, right? The rate will determine what payout you will receive of the principal amount of the gift, right? The minimum being $25,000 to set up a charitable gift annuity here at the Community Foundation, right? So the donor donates a minimum of $25,000. They will receive a charitable income tax deduction in the year that they establish a gift, and then based upon their age, they're going to receive a percentage payout for the remainder of their lifetime. When the annuitant passes away, whatever is left goes to charities. And the rates set by the American Council on Gift Annuities attempt to have roughly 50% of the principal value of the gift left to charity upon their passing. That's why these payment rates are determined by the American Council on Gift Annuities. They're not commercial rates. You can't shop around, right? You won't go to the University of Chicago and get a different payout rate for a charitable gift annuity than you would receive from us. So what are the benefits of doing this? Why would a donor do something like this, right? If they have a charitable interest, why not just give a gift to charity? Well, oftentimes donors are attracted to these kinds of gifts because they can supplement retirement income and of course support charitable work. There's a stable income stream even in volatile markets, so it's not just like playing the market and living off your equity stream, right? These are going to provide a stable income stream, and the income can be received also by a loved one. Some people will see that this is an advantage to set up for a spouse or for a different member of their family or a different loved one. This is another factor that we can dig into in further detail. Donors aged 70 and a half can use up to $55,000 of a qualified charitable distribution from an IRA to fund a charitable gift annuity. So let's go, that's a lot of acronyms. Many people have IRAs out there, right? Individual retirement accounts. And when you hit 73, you are required to take a minimum distribution. Now for some folks, they don't want the income because it can actually bring them into a higher tax bracket. And so that motivates a lot of wonderfully charitable-minded people to do a qualified charitable distribution. That's the QCD, right? So other folks say, well, I don't want to say goodbye to the entire income stream. What else can I do with it? You could use it to fund one of these charitable gift annuities, right? The maximum you can use, however, is $55,000. This is a brand new phenomenon that was established by the IRS and Congress, Secure Act 2.0, about 6 years ago. So utilizing assets from your IRA to fund a charitable gift annuity, which is going to pay you that fixed income stream, is a brand new thing that you can do. So I can see the wheels turning. We can go over a lot of this again. I want to make sure we have plenty of time for Lauren, so I want to move on. Here's an example of an individual who had been thinking about a charitable gift annuity for years. We'll call her Ashley for anonymity's sake. She retired in 2025. She was looking to diversify her income streams. She was looking to have a stable source of retirement income, and she was looking for a valuable charitable tax deduction. So Ashley donated almost $150,000 worth of long-term appreciated securities to fund a charitable gift annuity. She deferred her payments, however. This is an option. You can defer the payments until a later date. So she didn't need the income until she turned 70. This is part of her planning, her financial planning, her tax planning, and her charitable planning, right? So she's going to receive a deduction in the year that she establishes the gift, which is part of her, she had an income event, so she needed the charitable tax deduction that year. She didn't need the income, though, for a couple of years. So that's called a deferred charitable gift annuity, right? Now, she's actually going to get a higher payout rate because the payouts won't start until she's 72, or 70, when she's 70. So she established this when she was 68, and when she turned 70, she's going to receive a higher payout rate than the year that she actually funded it. A lot of details there, I know. So from that gift that she established, she received a deduction, which is the estimated value of the gift to charity. She's going to receive annual fixed payments of almost $11,000 for her lifetime. And the remainder, 50% of the remainder will go to the Foundation Forever Fund, here the Community Foundation, which supports the work of the Community Foundation. And the other 50% will benefit other nonprofit funds here at the Community Foundation. Now, for other charitable organizations that offer charitable gift annuities, of which there are only a few, such as universities often are large enough to have the administrative capacity to administer and invest these, typically 100% of the remainder is required to remain at the charity with whom you establish the charitable gift annuity. So at a university, for example, if you're going to establish a charitable gift annuity, and they will be making the payments to you, and they will be investing the proceeds, they will be ensuring that you get the tax documentation, they're doing all that administrative work. They require that the remainder of the charitable gift annuity stays completely at the university, right? Or at the Rotary Foundation, it stayed completely with the Rotary Foundation. Here at the Community Foundation, we have a different policy. 50% of the remainder can go to other nonprofit funds that are here at the Community Foundation, right, to support our nonprofit community. And half of it will benefit the operations of the foundation itself. So this is one other story that I'll move on to quickly. This is this is an example of a donor who didn't need the income himself, but he was thinking about how he could support a very, very loved one, right? In this situation, David's mother had passed away. His mother's caretaker had not been included in the estate plan distributions, and he thought, I would love to make a gift to these folks, right? But being savvy as he was, he thought perhaps there's something that I could do a double benefit with. Not only can I provide a stream of fixed income payments to the caretaker and her spouse, but the remainder, when they pass away, will go to the charities of their choice. So this is a kind of gift that has these double benefits, right? You are caring for another person by having that income stream, and you're able to support charities, right? David also got the benefit of receiving a charitable tax deduction when he set this up for this couple. So it is a smaller amount, right? Of course, the amount of the principal and the age of the beneficiaries will determine the payout for their lifetime, but it was his way of making a gift to them as well as supporting charitable causes. So you might say, well, this is an interesting thing. I don't know if it's really right for me. However, these are pretty simple to set up. Lauren's going to talk about charitable remainder trusts, which can be a little bit more complex, but there's an elegance to these. Right? And it's a tool that can be utilized if it fits your purposes. They're not for everyone, right? We only are able to set up charitable gift annuities for people who are aged 60 and older. If you imagine that the idea is that the payment rate is established so that there is something left for charity, if you establish one of these things for a very young individual and there's payouts coming from the principal for their lifetime, there's not going to be a whole lot left, right? So these are only for individuals who are indeed older. Another benefit is that I mentioned the payments can be immediate or they can be deferred, right? You could set one up at 65 and say, I don't need the payments until I'm 75. And in fact, you're going to get the payout rate of a 75-year-old because the payout rate is determined by when you actually start to receive the income stream. The payout rate is not determined by the age necessarily of when you fund it. The two may be the same. You may decide to start to receive income payments immediately, but that's a different way of planning these things. As I mentioned, you can, once in your lifetime, use assets from your IRA, also known as a QCD, a qualified charitable distribution, to fund a charitable gift annuity. And there are special rules around these. And then, of course, it is the case that this is the policy for the community foundation. If you wanted this to support, one other organization, you might think about it differently. So that's what I have about our charitable gift annuities. I'd like to move on to Lauren's presentation, but I do want to ask, and I know we're going to have a big Q&A session, but if there's anything burning right now before we move on, is there anything that, yes?
Thank you. That was really great. I just wanted to know, for example, in Ashley's example, for the amount of interest that was given on the almost $150,000 that was given, seems relatively high, and I'm not very good at math, and I didn't have time, but it seemed like roughly it was more than 7 or 8%. So then I was wondering, you said it's not fixed to normal interest rates, but does that mean? So I'm getting that means it's drawing down on some of the principal. It's not just like an interest equation on wherever the money might get invested by the community foundation.
Right, exactly.
So there's a formula of how much it gets drawn down based on how long would be estimated to live.
Yes.
And that's what you were talking about, that formula being determined.
Yes, and we will do, I want to, let me go, hopefully this is at the very, very end. I'm going to just skip ahead because I think this is actually a very good question. Sorry, everybody, this is going to be a little bit clunky. Okay. It's a lot of numbers on a page. Yeah. But one of the things that we can do here at the Community Foundation is utilize our software to run the numbers for you, right? Yeah. So you can say, can I have a personalized illustration? I'm 73 years old. I'd like to see what this would look like. What would it look like if I actually deferred the payments till so in this example, it's very difficult to read. The beneficiary age is 72 years old, right? So you say, and actually it's better we put it to the date because the nice thing is they'll round up your birthday to the next one in the next 6 months. Okay, so 72 in this example. If this donor were to receive an immediate payout, they are eligible for a rate of 6.6%. That does not alter based upon the investment performance. We take the assets and we invest them in a charitable gift annuity portfolio, right? That is maintained separately from the other assets of the community foundation. So this is one of the reasons why these things are a little bit more complex to administer than a lot of charities have the chops to do, frankly. We are able to issue charitable gift annuities because we are licensed with the Department of Insurance through the state of California. And we are required to maintain a reserve account as well as a surplus account, right? So those are invested, right, separately from our other. We are required by the Department of Insurance to invest these things, and we will make payments to you. We are obligated contractually to make payments to the individuals who are listed as the annuitants for the lifetime. So it is the case that people will outlive their expected lifespan, and we will continue to make payments to you, which is why we maintain a surplus account, right? So that's an excellent question. So in this case, if this individual were to defer the payments until they were 74, it just happens to be that 7.4% is the payout rate they would receive, right? Now, a charitable trust we haven't talked about yet, so you're not allowed to look at that.
Right.
So in this case, with the principal that was donated of long-term appreciated securities, the principal is $100,000. The charitable deduction is going to be $37,737 available to the donor in the year that they establish the gift, right? Now, if this is deferred, you're going to get a larger deduction. They're going to be making payments to you for a shorter period of life, right? The annual payout will be $6,600 fixed, $7,400 fixed. One of the benefits of charitable gift annuities that I did not mention is that a portion of the income is tax-free. It's considered a return of principal. You are not going to realize the capital gain. If you were to donate appreciated securities into a charitable gift annuity, the charity, us in this case, will receive those assets, and the fair market value of the securities upon our receipt is going to be the value used for the charitable gift annuity. If you were in a different scenario to liquidate those securities, take the income to live off of, you're going to have to pay the capital gains up front. Instead, in this case, the capital gains income is spread out over the lifetime of the gift, and a portion of that capital gains income is forgiven. Why is that? Because a portion of this principal amount is going to charity. And if you make a charitable gift, you're going to get a charitable tax deduction for that amount. You see that how these have these tax advantages? It's a lot of things to think about. And so we say, take the illustration, go talk to your advisors, talk to your CPA, talk to your wealth advisor, see if these will make sense for you, right? And we're here also to run illustration after illustration. You say, let me see what it looks like if I turn 80. Let me see what it looks like if I fund it with $200,000. Let me see what it looks like if I fund it with cash. And I can run those illustrations for you. Boom, 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 boom. Okay, I want to, yes.
If your donation of an appreciated asset takes the form of a stock,
Mm-hmm.
and the value of that stock goes down, am I affected by that?
No. It's once we receive the assets, we're going to liquidate those and reinvest them in our portfolio right away.
So if I give you stock in XYZ company, you're actually selling
Yes.
XYZ stock?
Yes.
Okay.
Yeah. But because we as the charitable entity are selling it, there's no capital gains tax to you upon the receipt, right? But the
Right.
yes. Okay. Yeah. Mm-hmm. Chris.
Just clarify that, you can only do the $55,000 from your IRA once in your life.
Once in your lifetime. And that has been increasing with inflation over the years. So last year was $54,000. This year is $55,000. There's a lot of buzz in the charitable gift community, plan giving community about whether or not that'll continue to increase, right? And will they make it twice during your lifetime? It feels a little bit arbitrary, but it's something that's moving in a good direction for a lot of people with these kinds of interests. Yes.
This is going to really sound stupid, but she's got Enron stock.
Uh-huh.
Okay, so she sells she gives you the Enron stock. You sell them. What do you then invest in?
We are investing the liquidated proceeds. No, we're going to sell your stock And that the proceeds from that will be reinvested in our investment pools.
In this pool?
Yes, yes. Yeah, okay. Okay, all right, thank you for your great questions. I really want to turn this over to Lauren. I'm going to flip back through a lot of slides here before I do that. And CRT. Oh, I'm pointing it in the wrong direction. Okay. All right, thank you so much. Here we have Lauren, finally.
Thanks, Kia. She can keep that all in her head. I like notes, so I'm going to do that. But hi, everyone. I'm Lauren. I'm a local estate planning attorney, and I'm talking about charitable remainder trusts, which, just like CGAs, give you this double benefit, the opportunity to give to charity while also getting some kind of lifetime income. Point that way. Mm-hmm. All right, so what is a charitable remainder trust? It is an irrevocable trust. So before I go any further, does anyone know what is anyone familiar with what an irrevocable trust means? A little bit? Okay. Well, for those who don't know, essentially an irrevocable trust means it's its own tax-paying entity for the most part. It can't be changed once it's set up. Now, there are exceptions to that, which we'll go over, but for the most part, you're setting this up. Once it's done, it's done. So we are creating a charitable remainder trust. It's an irrevocable trust, and this depends on the type of trust you choose. You pick either a fixed dollar amount that's distributed out to you annually or a percentage. And the difference between that depends on which trust you choose. The colloquial terms are CRAT and CRUT, and they stand for Charitable Remainder Annuity Trust and Charitable Remainder Unit Trust. And the difference is the distribution that's paid out to you. Now, the Community Foundation has specific rules on what they'll accept with the Charitable Remainder Trust. I'm going to give you a more general impression of if you had a Charitable Remainder Trust with anybody in the world, what it can be. But talk to Kia if you want to know more of the specifics. It says here that typically the lifetime distribution to you has to be 5%. It ranges. It has to be a minimum of 5%. It could be up to 50%. Most people usually go 5 to 10% route. And when it comes to a fixed dollar amount or a percentage, well, with the fixed dollar amount, you're looking at what is 5% of the estate when you contribute to the trust, and you're getting that same amount every year. The percentage is you're looking at what is 5% each year, say December 31st. What is 5% of the estate? Okay, now you're getting 5% for that coming year. So depending on which one you choose, it could be a fixed amount or a variable amount. Now, this is talking so far all about the lifetime income to you. The also benefit is that at the end of your life or at the end of the term, depending on what you pick, the remaining assets go to charity. Now, the trust is controlled by IRS rules and regulations, so it has very specific requirements that have to be met, including there has to be at least 10% left in the trust in the end to go to charity. So depending on how much you decide you want to fund this with and what percentage, just like the CGA, the Community Foundation or a university has the software that they run through the scenario to say, what kind of income will this give for you and what makes the most sense so that we still fall within the IRS rules. Also, the asset growth in the CRT is tax-free. So once you put money in there, it will grow, you're not taxed by it. The income, I say, is partially tax-free, and that's because just like with the CGA example, say you contribute to the CRT with appreciated assets, like NVIDIA stock. The Community Foundation, if they're the trustee, is going to go then and sell the stock. And if it wasn't in the CRT, if you just sold the stock, you'd have to pay capital gains in that year. Well, now you don't. You get to spread it out over your lifetime as the income comes out to you. And just like a CGA, some of that income can be taxable to you. Some of it can be a return on principal. And then just for your notes for Community Foundation, the minimum to create a community CRT is $100,000. All right, so we talked about the donor can contribute appreciated property. You can also contribute cash. You actually can contribute a lot of different assets, but for the basis of our program today, we're going to say that and not talk about liquid assets. You put into an irrevocable trust. It does require an attorney like me. So this isn't something that you can just go straight to the community foundation. There's going to be a few other players as part of it. One of the tax benefits, it creates immediate charitable tax deduction for you on your tax return that year. So you are going to be able to deduct that tax depending on what you contribute to the CRT. Say it's appreciated stock, you can take a deduction up to 30% of your adjusted gross income. So what if that means, you know, you can't take the whole deduction that year? You can carry over any unused deduction for the next 5 years. So this is something that can benefit you on your taxes for up to 5 years. And then as we mentioned, like if the community foundation's the trustee, the assets will then be sold and reinvested at that time. We already talked about the fixed dollar amount or the percentage that's paid annually. I mentioned paid to you. You do not have to be the beneficiary. It could be anyone you pick. So for example, I like to bring this up because I also deal with special needs trusts. A special needs trust can be a beneficiary of the life income from a CRT. So this is someone who is, say, maybe your child who's on government benefits, but you want to make sure they have some money set up to benefit them. So you have a special needs trust for them, which allows them to have funds on the side and not have it count towards their government benefits. This allows another way income stream to come into that special needs trust to keep it funded for them. All right, and then as we said, either at the death of the beneficiary or at the end of the term of years, the remaining assets go to the charity of your choice, depending on if you go with the community foundation or not. In general, this is one of the exceptions to that irrevocable trust. You can change the beneficiaries over time. So if you set something up and you say, actually, no, I don't like that group anymore, you can change that for the most part. All right. All right, so the example I gave with the assets, a lot of this is to, a goal of this is for diversification. So maybe you have a lot of assets in Apple or NVIDIA or something, and you're concerned, hey, it's doing great now, but it might not do great forever. This is a way to get that out of your estate and allow it to be reinvested in a diversified portfolio. As I mentioned, it generates that immediate charitable income tax deduction that you can recognize over up to 5 years, and you don't have to recognize any capital gains on the sale of that stock right away. And this is also a great vehicle to use for real estate. So I've been mentioning stock a lot, but this could be something with your vacation home or rental property that you don't necessarily want to deal with anymore. You can contribute to a CRT. All right, so here's just one example, Apple stock. If we were to contribute $2 million of Apple stock to a CRT, this has a 5% distribution per year to the beneficiary. They are seeing an immediate tax deduction of $850,000. They can take up to 30% of their AGI of that in the first year, and then carry it out over the next 5 years. And then they're getting up to $3.2 million of lifetime income coming out of the CRT to them. And then at the end of your life, we have even more, $3.6 million that can go to the foundation and to the charities of your choice.
And that's assuming like a 7% payout, or excuse me, investment return. So sorry to interrupt, but like the numbers can be pretty wild for folks when they look at this, right? It starts out as $2 million. You're going to receive $3.2 million in your lifetime of spread out income payments. And on top of that, there's a $3.6 million gift being to charity that started out with a $2 million set of assets, right? This is presuming about a 7% return on the investments, which is what we typically see with the community foundation investment returns. So this is just an interjection, but that's how these strange numbers work out for folks. Yeah.
All right. All right, so a CRT, the trust itself, as an irrevocable trust, as I said, it's its own tax-paying entity. Well, it doesn't actually have to pay tax. It's tax exempt. However, just like a CGA, the income out to the beneficiary is taxable, or a portion of it could be taxable. It is tax exempt. A CRT does require, though, a return. It's known as an informational return that you have to file with the IRS, and if you live in California, with California Franchise Tax Board each year. Now, if you're not the trustee, but for example, the community foundation can be the trustee, they'd be in charge of filing those every year. So one less thing for you guys to have to do. Taxation depends on the type of income inside the trust. So the trust is going to be reinvested through the community foundation. So it's going to have probably ordinary income. It's going to have capital gains, especially if we've sold long-term capital stock. And then, as we said, there could be some return on principal. So just depending on what income generates during the year, that's going to come out to you. All right. And the 4-tier system, I'm not going to, basically I went over it, but ordinary income comes out to you first, then capital gains, and then that return on principal. All right, is the CRT right for you? So as you can see, it's a bit more complicated than a CGA. It does require you to work with an attorney and pay an attorney to create it, but it can be a great vehicle to get that real estate, that stock out of your estate and still benefit yourself and a charity. You are responsible for the income payments that come out, but the K1s, the informational return, if the community foundation is the trustee, they cover the fees on doing those returns. Still have to pay for me, though. All right, here's an example. Is this one for me to do?
Sure.
Yeah. So in this example, Frank and Maria give their donor advised fund. They give to a donor advised fund and would like to support more youth causes as part of their legacy. Frank is 82 and wants to simplify their estate, reduce tax burden, support students seeking scholarships, and plan their retirement income. They have a vacation property they no longer use. They have held for more than 1 year. That's important because that means it's long-term capital gain. Oop. So here's the example. They create a charitable remainder trust with an attorney. They contribute the vacation property to the house. Now the vacation property, if it's just kept as a vacation property, would be liquid, so it wouldn't meet the requirements of the IRS rules about income coming out. So that's why Community Foundation, for example, as the trustee, would turn around and sell the vacation home and invest it in something that generates income so that we can meet the requirements. As a result of the sale, this doesn't tell you what the basis is and all of that in this scenario, but it results in you getting an immediate $1.26 million income tax deduction and about $90,000 of annual lifetime income. And this again was based on Frank's age of 82. And then when he passes away, we have the rest going to that fund at the foundation. So they'll leave a legacy of support to students through a permanent scholarship fund with the foundation to support student educational attainment forever, which has, is this a true story here? Has awarded 5+ students with over 100,000 so far. All right, I think that might be the end of where I'm going. So now we're comparing the two life income gifts.
Yeah, thanks, Lauren.
Yeah. Oh, before we move on,
Yeah.
any questions for me? Again, we'll have the Q&A, but any questions, any terms I said that don't make sense? Yes?
Not to the terms, but just, is there a cost to setting up the trust itself?
There is.
What would be a good ballpark to plan on?
Good ballpark. It depends on, the complexity, but generally maybe $2,500, $3,000.
Kind of a one-time?
It is a one-time expense.
Okay, is that tax deductible at all, or?
It is not under the,
To butter that up.
yeah. Unfortunately, since 2016, attorney fees are not tax deductible anymore.
Yeah.
Sorry.
I just have one question.
Yeah.
When we're designating beneficiaries, can that be sort of any 501c nonprofit, or what are the parameters of of a beneficiary?
So Community Foundation has their own rules. For the IRS, though, essentially, yes, it can be any 501c3. I think under the IRS rules, it has to meet the terms of a beneficiary under Internal Revenue Code 170. But essentially, yes. So it can't be to, I don't know, a friend that you want to support. It has to be an actual charity.
And did you say those beneficiaries could change over time?
Yes, so with the general charitable remainder trust, that's one of the provisions that can actually be changed. You do want to do it through your attorney because it requires an amendment to the trust, but those are the one things, along with, say, your trustees, that you can change too. All right, I'll turn it back to Kia.
And we can do another Q&A. Yeah, thank you, Lauren. So I will say before I go to the comparing the life income gifts, one slide that I don't have is what the role of the Community Foundation would be in this. So Lauren has gestured to several of the rules that we have. We do have policies. If we are acting as the trustee of your trust, we do have policies. Now, you can set up a charitable remainder trust with an estate planning attorney like Lauren and not be subject to any of the policies of the Community Foundation, right? You are subject only to the rules of the IRS that will allow this particular type of entity, a charitable trust, to qualify as a charitable trust, right? So there are rules regarding the payout structure, et cetera. One of the big ones is that to qualify by the IRS as a charitable trust, as Lauren mentioned, 10% of the remainder is expected to go to charities. That's what makes this thing a charitable entity, right? So think about this. When you're setting up this trust with an attorney, you are setting up, it has its own tax ID number. It is considered a charitable entity, right? It's not a 501c3 that's going to go and do programmatic work like Save Our Shores or something, right? But it is a charitable entity. It qualifies as such because it will be making that charitable gift, right? That charitable distribution at the end of its termination. So there are rules around these things. We will step in act as the trustee for this trust by investing the liquidated trust assets, right? So let's say a piece of real estate is deeded into the trust. Now the trust actually owns this property. As Lauren mentioned, that thing can't pay income to you if it's just sitting there, right? It has to be sold. The income that's generated from the sale is what's going to come back plunk into the charitable remainder trust. Someone's got to invest that. Someone's got to make payouts to you. Someone's got to give you tax forms. Someone's got to do the taxation of the charitable trust itself. The charitable trust itself is being invested. It's going to have, dividends. It's going to be reinvested. It's going to generate income. So there is a trust taxation process that we administer if we act as your trustee. We administer the payments to you, right? We're going to do the calculations. If it's a charitable remainder unit trust, this is the type of trust that Lauren mentioned will pay a fixed percentage of the trust value, right? So let's say that trust starts out at $100,000. It's going to pay you 5% of $100,000. What if it goes up to $125,000? What if it drops down? Because that's one of the things about the charitable remainder unit trusts. It can fluctuate. It's paying you a fixed percentage of the assets inside of the trust. We, as the trustee, will do the calculations for you and let you know, here's what your payout's going to look like for the next year, right? And those payouts could be quarterly or once annually or monthly, right? So we will do the trust statements for you. These are the roles that we will play as the trustee. If you set one up with an attorney, you then are responsible for finding a trustee to do all those responsibilities as I've described, right? You can go forward and do so. You have to find an accountant to do the trust accounting. You have to make sure someone is investing properly and making the payments to you. So as a result of the fact that we will take on those administrative and investment responsibilities, we do have policies. We say that the trust payout, if we act as trustee, must be between 5% and 8%, right? That's for a unit trust, right? So 5% and 8% of the principal value of the trust assets is going to be making a payment to you on an annual basis. Why? If we're going to be paying you 25% of the principal that's in the trust, let's say that's the contract that we've signed with you, we're going to be paying you 25% for your lifetime. Guess what's going to happen to the assets inside the trust? They're going to diminish quite a bit, right? Now the IRS says, well, as long as only 10% is left, it still qualifies. We're a charitable organization. We want to do good for our nonprofit community, right? And so we, like frankly, most other charitable organizations that sponsor and act as trustee, we typically see 5%. We might go up to 8% if you're a much older individual, meaning frankly that you won't be receiving payments for an extended period of time, which means that there's going to be a very significant charitable benefit, right? We can go up to 8%, but our gift acceptance policies say that the community foundation, if we're going to act as trustee, we do have an interest in not only providing you with this interesting giving vehicle, but also having a gift to our charities, right? So I just wanted to go over those. You have a lot more flexibility if you set one of these things up on your own, but it is your responsibility, either you yourself or the trustee, you're going to be investing these things with your wealth advisor, you're going to be finding your tax accountant to do all the accounting of it, right? Sounds complicated. So we take on that role, and as a result, we have these policies.
Sorry, can I interrupt?
Yes,
really
please,
quick?
please.
You brought up something that I forgot to mention, and it's kind of when you go to choose between an annuity and a unitrust, there's pros and cons for each. Annuity, you get the same amount every year no matter what. So the benefit to it is you have certainty in what you're going to get. It's going to be the same. The downside is it's not keeping up with inflation. So as the years go on, you get that same amount. It's not going to go up. It's not going to go down. It's set. The unitrust, well, there you have the opportunity to keep up with inflation because it is going to depend on the value of the overall estate each year. Now, you do run the risk, as Kia mentioned, of the value going down. So that's the potential downside is the unitrust amount can go up for you. It can also go down. So I just want to mention that.
Yeah.
Does the foundation exact a fee
Yes.
annually for managing all these value services?
Yes, there's a fee that is attributed to the actual vehicle itself. You yourself, as the individual who set one of these things up, will not realize a fee on the administrative and investment services that we provide inside of these.
Okay.
Yeah. It's typically 1% is the fee that we're charging.
Okay.
Yep.
And did you say that the community foundation requires 50% to be left over versus the 10% of the IRS requirement?
Yeah, so no, so in any case, for any charitable remainder trust, 10% has to be the minimum that would be left, right? We have an added requirement that whatever that remainder is, let's just say that we happen to allow you to have a very, very large payout rate, right? That whatever the remainder is, that 50% for a CRT will remain within the community foundation to be invested in one of our funds here, right? We have multiple funds that have different purposes. And the other 50% of that remainder can go to any charitable entity of your choice.
Right, okay.
Yeah, so that's a different rule than the 10% rule. Yeah, yes. Yeah, so we're looking at the comparison between these two. With the community foundation, it is a $25,000 minimum to set up a charitable gift annuity. At other charitable organizations, it might be a different amount. So this is our policy. It's a $25,000 minimum, right? The income, as we described, is going to be fixed. That's based on age. Let's just do the comparison. So the basis of the CGA has to be $25,000. The CRT is larger. And partially is that because of the administrative requirements, as I've described. The income with the CRT can be fixed or variable. The charitable remainder annuity trust, which again, like the charitable gift annuity, is not necessarily going to keep up with inflation. If you do the charitable remainder unitrust, which is what we see a lot of people doing with these, they like the idea that the income can grow over time. Right? If the investments are growing larger than the income rate that's paying out to you, the expectation is that this is going to grow over time, right? The The complexity level is a simple contract with a community foundation. We can set these up very, very quickly. There is more complexity with the charitable remainder unit trust. The income is predictable. There is income growth in the CRT. This is one of the biggest things, though, and Lauren has done a great job of highlighting this specifically with our example of Frank and Maria, right? Real estate is a fantastic asset to use to donate to a charitable remainder trust. This is one of the things one of the reasons why, for those of you who attended our previous, this seminar follows upon the seminar on real estate, right? And that was a packed room. That was a full room. People are interested in how they can avoid, frankly, the capital gains tax upon selling these highly appreciated pieces of property. And for those people who have multiple properties, particularly rental properties, where they've benefited from the income stream, but they no longer want to manage it, this is a very elegant solution, right? It does require an attorney to get involved. It does require you to think through the different aspects of what it would involve to actually do this type of a transaction, but it can be a fantastic solution, which is why we're following that real estate presentation with this presentation on CRTs and CGAs. And we've described this benefit to charity. I think this is going to bring us to the end of our, oh, there's Lauren. So again, if you did want to talk about what an illustration would look like for you, please feel free to reach out to me. I can run these for you, as many as you'd like. Different scenarios. We can think about benefiting you and a spouse. That's going to change the payout rate. We can look at different assets that might be utilized. We can talk about how this can actually benefit the charities that you care about, right? And that's really what we wanted to present to you today. And Lauren is an excellent resource for you to talk about what would be involved in the CRT. You have her contact information. She has cards for you as well.
I put them on the tables. And
on the table, we'll give you those. Oh, and this is going to be our next event, but I'm going to stop here and just ask again if there are other questions that you have about charitable gift annuities, why people set these up, how the numbers work. We've had a few good questions here, but I'm wondering if there's any lingering ones. It's a lot of information, yes.
Do you have a list of the local community nonprofits that you work with, or how even local organizations could become part of your network of?
Yeah, we essentially can benefit any of the, we would set up funds that are held here to support those local nonprofits. So if it's a charitable remainder trust, again, 50% would go to the funds held here, and we do have a list of those funds. 50% can go to any other charitable organization, you know, University of Maine or whatever it might be. With the charitable gift annuities, it is a little bit different. We want 50% of those funds to remain here to support our foundation forever, and then the other 50% could support nonprofits who have funds here, and we can set those up if there's not already a gift fund set up for them. So we do have a list of those, absolutely. We can provide that to you. Yeah. Yes.
Could you just clarify, was the last example that you gave, was that for the CGA, the charitable annuities? That it has to be a foundation, an organization and a foundation?
Yes.
Okay.
Yep. Yes.
Thank
Yes. Other lingering questions? Yes.
So how would it work for a CRT? You have secondary property, $1 million, but you owe $500,000 on it.
So the mortgage goes along with it. So it's a net. So say it's a rental property and you want to keep it. So there is the possibility you can keep the rental property. You don't have to sell and do that, potentially. It's the net value that is considered for the income coming out. So if you have a 5% unit trust, for example, they're going to look at the million less the 500,000 for a 500,000 value to determine. Now, the income from the trust can also be used to pay the mortgage payments to keep it going. too. To answer the question?
Yeah, so you don't have to sell it.
You don't potentially.
yourself.
Yeah.
You can still give it to the trust. Community foundation could sell it. Is that correct?
Right. So with any of these, you do not want to sell anything until it's in the vehicle. If you sell ahead of time, capital gains. So with the real property, with the stock, it needs to go into the CRT, into the CGA first, and then be sold in order to get that deferred tax recognition.
Mm-hmm.
Yeah.
So if it's apartment buildings
Uh-huh.
and it's deeded over to the community foundation,
Mm.
then the owner of those apartment buildings is totally out of the sale?
Good question. No, not quite, not quite. So you're going to deed the real estate into the trust, not to
I'm
us.
sorry.
Yes. So the trust now owns it, and the trustee is going to be responsible for the sale of. The trustee is not going to be us initially for a gift of real estate. So the initial trustee portion for a gift of real estate is going to be you, the donor, or we can work with you for a third-party entity to support you through the sale of the property. The concern is that with these specific kinds of giving vehicles, the responsibility is that there has to be income coming out of them, right? These are the rules. This is how this thing, it doesn't just sit there. There has to be income coming out. And so we would not want to, and the community foundation is also wants to make sure that we're going to be on the deed of properties that we can sell immediately. There's an even greater requirement for the sale of the property with these because they have to start generating income right away. And so we will oversee the trusteeship of the initial trustee portion of gifts of real estate while the gift is being sold, but we will not be named as the initial trustee of gifts of real estate into CRTs. We will come on as successor trustee after the real estate has been sold and it can be invested, right? And we do have specific portfolios into which these assets can be invested that we can talk to you about as well that may appeal to you based upon your concerns or interests. But that's a very good question.
So it's liquidated when you get it?
Yes, yes.
And the donor would still be, would be involved in the sale?
That's right. That's right.
So in this scenario, the donor would be the initial trustee and then
Okay.
turn the trusteeship over to the community foundation after the sale.
You don't want to be a property manager, huh?
No, we don't. No, I'm looking at Hillary right now. No. Jeez.
And I just wanted to clarify, when I said rental property could be held in there, it's probably few trustees that want to manage it as a rental. It might be a scenario where you continue to be trustee if you still want to handle that management, but most likely scenario is it's going to be sold.
Thank you.
Yeah.
For a married couple, do you both have to be over age 70 and a half?
For the CGA?
So, so the QC, the IRA assets going to fund a charitable gift annuity, right? It's only going to be coming from one individual's IRA, right? And so that individual has to be 70 and a half or older.
But if you wanted to do a CGA and fund it a different way,
Mhm.
not from your IRA,
Yeah.
do you still need to both be over 70?
No, you do both have to be over 60.
Thanks.
There's a lot of particularities, and no one expects you all to hold these specifics in your heads. And that's why, as I said at the very beginning of the presentation, we are here to support you with thinking about how these kind of unique giving vehicles might be a solution, right? They might not be. You might decide one of the other giving vehicles we have here at the Community Foundation, like a donor advised fund. It's going to give you a charitable tax deduction when you set it up. It's going to give you the capacity to make grants to charities that you care about over your lifetime. That's a great giving vehicle. But this is a different way of doing things, right? And it requires a degree of interest, commitment to having a charitable impact, but also the savvy to be able to think through the implications of how these might work for you or not. What are the best assets to utilize, right? And to say, from the very beginning, I described both of these as life income gifts. These also fall inside the larger umbrella of planned gifts. So when you think about planned giving, these are gifts that are going to be actually having charitable impact later, right? You're planning for the income, but you're also planning with the assets you're choosing. You're planning with the tax implications, right? It's a different type of gift than just saying, here's a check, thank you so much for the great work that you do, right? It's a different kind of giving vehicle. Yeah. Yes.
Can we be assured that the conditions that we say in the case of the CGA, we set up the CGA, it's subject to certain regulatory truths,
Yes.
certain interest rates, that once we lock in that CGA, will it be treated that way, the way we set it up for the rest of our lives, or will we be subject to Congress and changes in laws and all that stuff impacting it? Or do they sort of lock and load?
It's locked and loaded. I mean, it's a legal contract between you, the donor, and us as the contractual relationship individual, right? Charitable organization. It is a legal document. It is our fiduciary responsibility to adhere to the policies that we've described. In the contract language, it does provide a description of our responsibilities to you and our obligation to make those fixed payments for the remainder of your lifetime, which is in fact why most nonprofits don't offer charitable gift annuities, because if you were to live beyond your expected lifespan, and we've said we're going to be paying you 7.2% of the initial principal value, right? And you've lived way beyond your actuarial expected lifespan, it is on us, right? Which is why we have to very carefully manage the investments in our charitable gift annuity pool, and we have specialized investment managers to, in fact, be able to meet those contractual obligations. It wouldn't be very comfortable for an organization that is just, hoping to be able to accomplish its mission on a quarterly basis to be able to offer these things. And also, we have to be sure that we're going to be here in perpetuity, right? We're not going anywhere. The Community Foundation has endowed funds that tell us and affirm to our community that we will be here forever for good, right? And we will be able to adhere to the contractual obligations of these gift annuity contracts. Yeah, absolutely. Yeah, great question though. Other thoughts, questions? One, yes.
I have one more question. Thank you so much. So great, both of your resources. For the 50-50 beneficiary gift, the 50% of the Community Foundation, do the donors get any say in the organizations that the Community Foundation works with as far as how it's ultimately distributed? Or is that just strictly the community? Like, just say there was a local school or Saber Shores or something that people were really passionate about, besides their nonprofit organization of choice.
Yeah, so the first portion, which is the Community Foundation, that can be to any one of the funds that we have here, right? And the funds themselves are going to be making grants that are going to be at the discretion of our engagement and impact group on an annual basis within that fund's purpose, right? So there's some discretion for you which fund here that you wanted to direct, right? But ultimately you could not name the specific nonprofit beneficiary of the funds that will be making grants on an annual basis, right? But on the other hand, the other nonprofit organizations, you could divide that remaining 50% amongst many different charitable organizations that you yourself get to determine. Yeah. Okay.
You can also create an endowment for the benefit of another organization. So if you had an organization that you really love that didn't have a fund here yet, you could create an endowment which would provide a perpetual resource for that organization.
Thank you. Love that.
Thank you, Susan. Thanks, Susan. Yeah. Okay. All right. Well, I think that draws us to a conclusion. I just want to say thank you again to Lauren. That was wonderful. Thank you. In your packets, you're going to have a survey. We really care about your thoughts on these seminars. They are meant to be informative and welcoming. If there were things that you would recommend that we do differently, Please take just a few minutes here as you finish up your last nibbles or drinks of coffee. I also want to gesture again to our next Generosity Forum, which will be featuring Kevin Hewer, who is here at the beginning of our presentation, our Giving to Meet Local Needs, and you can register for that online if you haven't already. And that is the conclusion of our presentation. So thank you for being